Well, let's take a look at more of this on the markets. We're going to go to Chief Investment Strategist for BMO Wealth Management, Young-Yu Ma. Thank you for joining us this afternoon. So obviously, anything that comes out about the Fed, and especially now with this 75 basis point hike, literally going to be on the horizon here. How much does this change the picture versus what the markets have already baked in?
I think the markets are mostly expecting a 75 basis point hike. So I don't think that's itself going to be market moving. But what Chairman Powell messages in the press conference will be potentially market moving. Is he going to come out and be just as hawkish as he was at the Jackson Hole speech? Or is there going to be some nuance in his language, the way that we saw out of Lael Brainerd today in her speech? So there's definitely going to be a lot of focus on the release and the press conference. But the 75 basis point hike itself is probably largely expected at this point.
Young-Yu, it's good to see you. What about the strong U.S. dollar? Yes, we're seeing a bit of relief. I don't know if you can really truly call it that today, but we are seeing the U.S. dollar index pull back just a bit. We've heard from a number of multinational companies over the last quarter or two referencing the strong dollar, saying that that is a huge headwind here for their business over the coming months, over the coming quarters. How much of this risk has already been priced in, and how does this set us up for earnings season during the third and fourth quarters?
That's a great question. I think a fair amount has already been priced in. If we look at large caps for S&P 500 companies, about 40% of their revenue comes from overseas. So the strong dollar, it's going to take a hit to their earnings once they translate those foreign revenues back to U.S. dollars. But I think that's largely understood now, and some of that will be forgiven by the marketplace as long as overall sales are holding up in local currency terms. So I think actually the strong dollar on net is positive for the U.S. economy because it does help to moderate inflation pressures. So you have this push and pull going on right now with a strong dollar. But I think given the prominence of inflation and the macroeconomic backdrop, we would rather have a strong dollar here that helps to soften the inflationary pressures going forward and at least have this temporary pullback from the strong dollar in earnings, recognizing that this dollar strength probably isn't going to last for years and years.
On the flip side of it, as Shauna mentioned coming in, the weakness of the pound, lowest level against the dollar since 1985. What does that tell you is coming to the UK as a new prime minister ushers in her era?
Well, the UK and all of Europe, for example, the euro is below parity at this point. They have a big set of challenges ahead of them. There's no question about that. So I think if we think about which pairing the dollar looks strong against in terms of the pound, in terms of the euro, the dollar will probably stay strong. Some of the other currencies, I think that there's a prospect for a shift in the coming months or coming quarters. But certainly Europe is front and center in terms of challenges regarding energy, economic growth, long-term structural changes that are difficult to make in the economy. So that's definitely reflective when you see the pound at these multi-year lows.
And when you have a lot of this conflicting data that's trying to reflect the strength of the economy, but obviously we have some stickier parts of inflation as well, what does this mean for how you're looking at your portfolio and what you're perhaps rotating in or out of?
Well, we have this push and pull going on right now. So we do have some parts of inflation that are looking sticky, but are probably actually, if we fast forward maybe a few quarters, probably going to start moderating as well. We have seen several signs of moderating inflation. If we look at gas prices, commodity prices, even wages look like they're starting to level off. So in terms of how that translates to a portfolio, we think now is really a time for a balanced approach. You don't want to be over your skis in terms of risk, but we also want to be reflective of the expectation that we think a soft landing is still in the cards. We don't think we're going to have a deep recession. We think economic growth is going to slow. We think at some point the Fed is going to realize that inflation has come down enough. And at that point, we'll start to level off more. So portfolios, we think strategic targets, long-term outlook, and not having an abundance of risk right now probably makes the most sense.
Sounds like it might not be as bad as we had initially feared. All right, Young-Yu Ma, thanks so much for joining us this afternoon.